What you're looking at here is a historical graph through 2018 of Lowe's company. And what you see is a plotting of the earnings per share, which is the orange line, the dividends before they've been paid out, and then the dividends after they've been paid out. And I want you to notice that from this time frame, Lowe's company had grew earnings at 12.88% per annum. This next graph, looking at the same time frame, is Home Depot. Notice how similar the two graphs are. Here the growth rate was 12.73%, but notice how the earnings rose and then fell during the Great Recession of 2008 and 9, and then recovered again in Home Depot's case, in exactly almost identical picture to Lowe's. But one of these two stocks is the better investment. Watch this video to find out which one. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And I'm using this first video here to launch a new series that I've come up with. And I used to do subscriber request Tuesdays, and those of you who've been regular viewers of my videos know that that became cumbersome, and it became, we were covering a lot of stocks that I really wasn't comfortable sharing with you. And as a result, I've decided to switch that. So what I'd like to do, my role, and I've always seen my role here, is really trying to help people be more prudent, better informed, long-term investors, especially value investors. After all, I'm known as Mr. Valuation. So what I'm going to do here in today's video is I'm going to take a comparison of Lowe's and Home Depot. And I'm going to look at them both from a lot of different angles because, as I pointed out in the introductory part of this video, these companies are very similar in many ways, and they've operated very similar, but yet over different periods of time, they've actually created quite different investment results for their shareholders. Sometimes Lowe's won, sometimes Home Depot won. And what I'm going to do here in this Principles of Value Investing series that I'm going to start doing here is to just try to help investors understand how performance is created, where it comes from, how to know and how to think about stock prices and valuations and earnings growth. One very important principle that I'm going to be covering throughout this series, and I'll sometimes be smart enough or I'll remember to mention it directly. Other times I'll just be alluding to it. But the point is, I think investors have to understand that value and growth are joined at the hip. Having a stock at good value doesn't mean you're going to make good money because the company may not grow very fast. And even overpaying for a stock that's growing very fast might turn out to be a better investment than a value stock. But the key is picking investments that meet your investment objectives and that are capable of doing a precise job that you're looking for. But in this first video, I'm going to compare two very comparable companies. I don't think you can find two companies that have such similar operating histories. And I want to show you how, valuation really impacts their results and how you can tell when one's a good investment and when one is not a good investment, because both of these have good growth histories. So let's go back and revisit. I'm going to start with Lowe's. I'm going to go ahead and expand it out here now and put it out to a maximum, chart. And here you can see Lowe's has grown earnings since going back to the very beginning of 2002, January of 2002, at almost 15% per year. Very consistent, very fast growth. And again, you see that operating history that I talked about. If I compare that to Home Depot, you see a very similar result, but not identical result. Home Depot grew earnings over this time frame at about 12.32%. So we have 14.99 versus 12.32. Now we would automatically assume, in which I always hate the word assume, because that, if you put a hyphen after the S or on the front of the U and after the U, makes an ass out of you and me, excuse my language. You get the point. Assumptions are what a lot of people do when they're making investment decisions. And when they're analyzing investments, they'll look at things like the historical track record without calibrating it for things like valuation. As I've always said, measuring performance without simultaneously measuring valuation is a job half done. So let's kind of analyze these. Now, if I look at the long-term performance of both of these companies, I'll start with Home Depot and look at its long-term performance. And what I discover is that a $10,000 investment grew to $71,000 and averaged about 10%. If I then in turn go to the performance of Lowe's, the faster growing company, a $10,000 investment grew to $93,000 or 11%. Now, what I've done here, and I want to make this very clear, this is the new version of Fast Graphs. We have some new exciting features for those of you who are subscribers. For example, we usually compare performance with the SPY or the Spider ETF, or just trying to compare it to the general market. Here you have a new feature that allows you to include a comparison ticker. So what I'm going to do is I'm going to compare Lowe's and Home Depot together as I go through this presentation today. So the first thing you see here is that Lowe's turned out to be the better investment in this case. And it was a faster growing company, so that makes some sense. When I go back to the historical chart for Lowe's, and when I go back to the historical chart for Home Depot, I want to add some additional insight into this discussion. I'm going to include monthly closing stock prices on the graph. Now, one thing that I want you to notice is that Home Depot in this graph started out with a very highly valued PE ratio of 38 back on February 8th of 2002, and it currently has a blended PE of almost 19 and earnings yield, which I would consider subpar, of about 5.22. So it was started out significantly overvalued, ended up overvalued, but less so. When I in turn do the same thing with Lowe's, and keep in mind, the first thing I want to always point out is, notice how the price does follow where the earnings go. Lowe's was also overvalued with a PE ratio of about 35, but it ended with a much better valued blended PE ratio of 15 and earnings yield of 6%, which is very close to the minimum threshold that I like to see. So now we are going to take a look at how valuation impacts that. The other thing I want you to notice is the market likes these stocks very much. The market has typically, over this long-term time frame, wanted to apply about a 19 to 20 PE ratio. Even though these numbers are precisely calculated, you should always be thinking of them as ish. Because likewise, when I put the normal or the market value PE, we get 19.44. So the market likes to value both of these stocks, I'm going to say, at around 20 times earnings. Okay, that's important, because you can use that as kind of an aggressive objective, if you will, and you can use the more, what I would consider, prudent 15 PE ratio that Ben Graham often talked about, said never pay more than 15 times earnings. And you can see that when the price is touching the orange line or slightly below it, those are PE ratios at 15 or below. You have gotten opportunities. Now, recently, after this massively long-running bull market we had, COVID is the only thing that gave you an opportunity to buy Home Depot at a 15 PE. And likewise, when you look at Lowe's, you had COVID, but then you also had recently, a matter of a couple of weeks ago, the opportunity again. But once again, you see so many similarities between these companies. But watch what happens here. Now, one of the beauties of this feature of this tool that I'm using here, the Fast Graphs, it allows you to calculate performance and look at it. So I'm going to switch to 15 years here just arbitrarily, and I want to make some observations before I go on. This is a time frame when Lowe's grew earnings at 18.86%. We'll call it almost 19% a year. The company started out, I want you to notice, at a PE ratio equal to the growth rate of around 17 or 18 times earnings. That's what you're using here as a valuation, is when the growth is above 15%, Fast Graphs automatically uses the Peter Lynch formula, PE ratio equals growth rate. Now, if I apply the same time frame to Home Depot and draw it, here I only get a growth rate of 13.19%. Now, I had a much better PE ratio of around 12, and the stock went from being, therefore, undervalued. Again, the normal PE stayed around 20, which didn't hit that until 2011. I just want you to notice the analysis that I'm doing here. But over these years, since coming out of the Great Recession, Home Depot grew at about 13%, started out undervalued. This is the effect that valuation has, ended up slightly overvalued. So now what we discover is our rate of return was significantly better than the 13% growth rate. We ended up with a capital appreciation of over 17%. Add in dividends and we get 18%. We also got significantly more dividends than the overall stock market, because here I'm comparing Home Depot to the stock market. So it dramatically outperformed the market. But now let's switch to Lowe's now. Lowe's started out with a higher PE ratio, 18 to 20, pretty much what the market is, It grew at 18.86%, but ended the time period undervalued on that basis. Here we're using a PE again of equal to the growth rate of about 18.66. That's what the orange line is. So let's now look at the performance comparisons again. And what we see here is Lowe's actually underperformed Home Depot, even though it grew faster. Primarily reason for that, what I want you to really focus on is what I often say, measuring performance without simultaneously measuring valuation is a job half done. We're measuring Lowe's at a time when it's currently undervalued at a very attractive 15 PE ratio based on this much faster growth rate in recent years compared to Home Depot, which started out, even better valued, but ended up overvalued at the end of the time frame, but only had a 13% growth rate. So these convoluting factors, the growth of the company, coupled with the valuation of the stock at the close, is what made the difference in these two investments. Home Depot, because it was overvalued, even though it grew slower, generated a significantly higher rate of return in the end, and also generated much more dividend income because the valuation was so much better over that time frame than Lowe's. But both companies still had, similar results. Run this at 10 years for Lowe's now, and now we get a change. We get earnings growth of 19.5%. So the valuation line is a little higher. Any of you that are subscribers, always check the growth rate. Here we have Lowe's growing at 19.5%. And if I go into Home Depot and compare it apples to apples, I only get 15% growth. Now here's a case where Home Depot has been trading at 22 times earnings, and it now would be undervalued on that basis here. If you're using the normal PE, it's still overvalued based on a typical 15-ish PE that a company growing at this rate should command. So now I go back to Lowe's and I'm looking at faster growth, but I have the headwinds of higher valuation in the beginning. So now when I compare the performance of the two stocks once again, I get an advantage to Home Depot, more dividend income, approximately the same capital appreciation, even though Lowe's grew faster than Home Depot. Home Depot was better valued, grew slower. It was able to generate significantly more dividend income, but the rate of return was about the same. My point is measuring performance without simultaneously measuring valuation is a job half done. So I think you want to do that even when you have very comparable companies like this. So now if I drop this to the last 7 years, now we see growth for Lowe's has averaged about 20%. When I go into Home Depot, I see that growth has averaged around 14%. And I want you to notice the differences here. At the bottom of the graph, you have the rate of change of growth each year. This is why I call this a tool to think with, an analytical tool. Here we get headwinds of overvaluation starting out with Home Depot. And when I go back to Lowe's, I also have overvaluation, but I have a much higher growth rate and I have undervaluation as far as the ending point, and I have overvaluation as far as the ending point with Home Depot. So once again, when I measure performance here and I compare the two, I get a much better rate of return from Lowe's now, which has actually grown significantly faster. I still get less dividend income, but I get much more capital appreciation. I get a 17% annualized rate of return instead of 12.77. So my whole point of this whole diatribe here is that these stocks, although very comparable to each other and very similar to each other, it really comes down to valuation becomes a primary determinant. They both grow pretty well. I want you to notice that Lowe's grew at very extraordinary rates over these last couple of years. Their fiscal year ends in January, and they had 12% growth in 2020, and that's with COVID. Then they had 55%, followed by 35%, and expected to still be double digits this year, going down to 12%. If I go to Home Depot and look at those same numbers, I also had, very good growth on Home Depot. I had 16% in 2021 versus 30 versus 6. Good growth, but much lower than Lowe's did. So, Home Depot is an A-rated company, as you can see here. And then when we look at Lowe's is a triple B plus company. Lowe's has long-term debt to capital of over 122%, which, by the way, means they also have negative equity. And Home Depot has long-term debt of about 96%, which they have a little better equity position, but not much better. So looking at these two companies, the similarities are astounding. But when you're analyzing performance, just don't look at what the historical results have been, is one of the primary messages I've been trying to get across here. Look at how and why those results were coming from. Look at the growth rates the companies achieved. Look at the valuations that the market was willing to pay for them, because you're going to notice a couple other things about these companies. Home Depot has a very good analyst scorecard, and Lowe's also has a very good analyst scorecard. Maybe Home Depot's is slightly better, meaning that analysts tend to be right, or the company beats estimates, or the analysts hit it right on the money most of the time. They miss it about 21% for Lowe's in the 1 year, about 14% in the 2 year. And similarly, they only miss it about 7% for Home Depot. So it's a little easier, I guess, you might argue, for these analysts to analyze, and they only miss it by 14% on the 2 year. So let's go ahead now and look at forecasting, because although you can learn a great deal from the past, as I've tried to go through in this video here, you can only invest in the future. Now, looking forward, if I'm using the 15 PE ratio as my most conservative valuation metric, Home Depot looks overvalued here. And if the company did generate the earnings that are expected here, it would actually give me a negative, slightly negative, call it break-even rate of return, 0.67% annualized negative rate of return. If I, in contrast, go to Lowe's, which has slightly better valuation and 10% growth, I would get the opportunity for double-digit growth investing in Lowe's today at this conservative 15 valuation. So I've got 10.5% growth expected for Lowe's. I've got 6% expected for Home Depot, which is kind of consistent with how the companies have operated recently. I've got Home Depot at a higher valuation. It's a higher rated stock, a little less debt, but yet the valuation means that it could end up generating negative rate of return for me, where Lowe's, which gives me a better valuation and slightly faster growth, could give me double-digit rates. Now, if I use the normal multiple for Lowe's, which is approximately 20 times earnings, it calculates out here at 19.46, you can always change that or study that by looking at what the historical PEs were. So I could go in here and put a 20-ish PE. Here's one at the 12-year. I could put the 20 PE in here, and then that would mean that, Lowe's would give me a chance to make almost 24% a year rate of return. If I went to Home Depot and, looked at the normal multiple here and Home Depot and applied that same kind of logic and tried to find roughly a 20 multiple for Home Depot, there's about as close as I can get there, then Home Depot would now offer me about an 11% rate of return. So again, these are what-if scenarios. What if the market continues to value it at a premium, as it always has? Then Home Depot might be a decent investment. But on the other hand, Lowe's, if they did the same thing with Lowe's, Lowe's would then become the much better investment. So looking forward, I like Lowe's today a lot better than Home Depot. But yet, if I can get Home Depot at an attractive enough valuation at times, then I would also be willing to invest in Home Depot. Now, I do want to make another point here, and I don't have time to go into it in this video, but I just want to interject the concept. I'm looking at these companies from the standpoint of long-term history here, and then, I'm starting to move into forecasting. But I want you to know that I can look at both of these companies through a lot of other metrics here. I can look at them through operating cash flows. Home Depot actually looks a little better valued that way. I do the same with Lowe's, and I go to the drop-down window here and I queue up operating cash flows. Now Lowe's looks even cheaper. Notice they had a little more trouble with operating cash flows than Home Depot did during COVID. So what you're trying to do is see what these companies have delivered for you on an operating basis, and then how the market has done that. One thing I like, Home Depot clearly covers their dividend with operating cash flow, as does Lowe's. So both dividends, 2%, 2.16% for Lowe's today, 2.48% for Home Depot. Both are extremely well covered by operating cash flow. The acid test to me is always free cash flow. Home Depot covers their dividend with free cash flow. Looking at Lowe's and going into free cash flow, they also cover their dividend with free cash flow, but not quite as well back in these years as Home Depot has, but more recently they have. So now I would start digging deeper into the companies here. My choice would be Lowe's. And so what I would want to do is I want to go into financials, and this new version of Fast Graph's got some really exciting features coming up. For one thing, we've got the health check, and I can look at, all these, I can look at margins, I'm not going to do it today, returns on assets, returns on equity, compare them to industry standards. I'm running it here for 10 years. I can look at, operating cash flow versus net income. I always want to see that equal to or higher, preferably higher, operating cash flow higher than net income. Long-term debt to capital, I can see if the company's been increasing their debt or not and how their debt levels stand up to industry standards. Remember, when rates were so low, companies were borrowing money because they could actually earn more on their money than what it cost them to pay in interest. Another feature that we're going to be adding here, we're going to keep the old fund graphs, by the way. And I still like the fund graphs because you can go in here and look at, price to valuations. Like here, I'm, looking at enterprise value to EBITDA, and I want to see, I've got a low 12.95 multiple here for Lowe's. If I did the same thing going into Home Depot and looked at the enterprise value to EBITDA on Home Depot, just as another comparison, and go into my ratios tab here, go into my enterprise value to EBITDA, I've got a much higher multiple, about 16.5. This is, a lot of people believe enterprise value to EBITDA is a better reflection than a PE ratio because it takes into consideration the whole enterprise value of the company. I think that's probably important. So Lowe's looks a lot cheaper here. Another exciting feature, and we've got a lot of work to do on this. We're going to be trying to provide some graphing ability on this, but I want you to notice we're now going to be including each company on Fast Graph's financial statement, the balance sheet, the income statement, and the cash flow statement. This, stays within our theme of helping you research stocks deeper and faster than ever before. So these are new features that you can look forward to coming up. But the bottom line is when you compare these two companies, each of them together, I personally today would argue that Lowe's gets my nod. It's I think the better opportunity today because I think the valuation is significantly better than Home Depot. But given the opportunity to buy Home Depot at a good valuation, I say a better valuation than Lowe's, my attitude might be different because of the similarities of these two companies. And I hope you saw that. So anyway, this has been Chuck Carnevale with my Principles of Investing video. I hope you enjoyed the video. My idea here with these videos, I'm going to try to keep interjecting some prudent practices associated with value investing. I'm trying to give you some insights at how value investing works, some very, insights into the principles of valuation, help you think better, think about stock prices, help you think about earnings growth and, the opportunities in front of you with these companies, and even show you some insights into researching them better. So anyway, this is going to be a fun series. I've taken requests, and I've appreciated the requests that you guys gave me. I'm going to be interjecting some of those requests in future videos. I'm going to be using some of those requests as a video in its own right. So kind of watch out for that, and I'll try to give you some insights into that. But this was an idea of to compare two very similar companies so that you can see how the effects of valuation and how much of an effect valuation actually had on companies. So, to put that into perspective, if you looked at how highly valued these companies were back in 2002, I want you to notice that there was negative rates of return, even though the companies did fairly well because valuation was too high. Valuation matters, and it matters a lot. And remember, value investing and growth of earnings are joined at the hip. Their total return is going to be a function of proper value, buying a stock at a proper value, coupled with how much growth and coupled with how much dividend income, if any, that it's liable to generate. Hope you enjoyed this video. If you did, ring the bell, give me a like, subscribe to the channel, and I look forward to talking to you guys again very soon. Thanks.